in interest rates, that from the Federal Reserve today. The biggest change was a decrease in the number of rate increases expected, from 4 this year down to 2. So does this cautious tone mean the Fed is worried about the global economy? I'm talking with Beata Caranci, Chief Economist, TD Bank Group. Well, Beata, is the Fed a little more worried than they were even a couple months ago?
I don't know if you got the sense from the communication they were more worried. What they absolutely did, though, is present a more cautious approach to the path of where the future policy rate is going to be. So this is the point that you made, that they actually lowered the median forecast, or what the Fed members were expecting, by about 50 basis points. They were looking for basically 4 hikes, and that's down to 2. However, they are stressing a bit more in the communication as a rationale for it, some of the volatility that we've seen on the financial side and the lower global growth trajectory that is accompanying it. And those two factors themselves are allowing the Fed to take a bit more of a pause and evaluate conditions.
So it seems to be a little bit hard to see exactly what they're looking at, because they used to say we're data dependent and that's all we are. And now they're putting a little bit more weight on what goes on outside the US and the rest of the world.
Yeah, so this is an interesting way that they've couched the guidance, because to your point, their mandate is really inflation in terms of maintaining stable inflation around the 2% target and a stable unemployment rate. And the unemployment rate is almost near where they anticipate is their neutral level. And things like core CPI recently just ticked up to 2.3%. That's not the one they target. They target another measure called core PCE. But both metrics are decidedly rising. And so if you have inflation rising and some pass-through coming through on the wage side, it's particularly in regions of the country that have higher skilled workers. So we're really noticing it in some of the areas in the northeastern states in particular. If those are happening and you still feel comfortable to leave rates stable, then what do you need to see for that to evolve going forward? So one of the things they did talk about is that the trajectory for even the domestic economy they feel is lower. Our own forecast has been adjusted slightly lower recently. So while they still are confident in the recovery, they just don't see the same impetus or need to raise rates to where we had expected you would need to get them, just as early as December. Their long-term path for policy rates was also lowered. So even when you get to the end point, they also see that to be a lower level than was the case in December.
And so was that the most significant thing you got out of today's announcement?
I did. The fact that they were communicating to markets that we feel there's a lower path ahead of us. And I think the markets took that in stride, because you saw the bond market rally and the US dollar fall. And so some of this sentiment that the Fed, this notion that it's not a prescription, that they're not going to move at every other meeting, and the way they communicate their path in terms of those dot forecasts, that's permitted to evolve based on the data they're seeing. So they're not hard and fast on the rules, but by the same token, it makes it harder to interpret.
Exactly. So did you change anything in your forecast? Where do you see us going?
No, this is perfect in alignment in our forecast, actually. We are anticipating for some time that the Fed would raise rates only 2 times this year. So we think the most likely place point is in June. However, every meeting is live, and they do have a meeting in April. So it's possible that if inflation, they'll get one more piece of data on inflation, they'll get another jobs report, and if you continue to see upward pressure on those fronts, I think we'd have to consider that could be a possibility.
All right, we'll keep watch. Thank you very much, Beata. I've been joined by Beata Caranci, Chief Economist, TD Bank Group. I'm Marianne Deveni. Thanks for watching.